We'll make a start now. Good afternoon, everyone, and welcome to this deep dive session on the proposed amendments to the Tier 3 not-for-profit reporting standard. I'm Jamie Cattell, and I'm a project manager at the External Reporting Board in the Accounting Standards team. And I'm joined today by Carly Berry, who is also a project manager in the Accounting Standards team. You'll be hearing from both of us intermittently throughout this presentation today. We'll also have some time to answer questions at the end, so please do submit any questions that you have for us using the Q&A function that you should find at the bottom of the screen. First, a quick introduction to the XRB and who we are. We at the External Reporting Board have as our vision that New Zealand prospers through effective decision-making for resource allocation informed by high-quality, credible, integrated reporting. But what we are and what we do specifically is that we are an independent Crown entity, and to achieve that vision, we are responsible for developing and implementing accounting, audit and assurance, and climate reporting standards in New Zealand. We exist to enable the highest quality decision-making for resource allocation for the benefit of Aotearoa New Zealand. What we're here to talk about today, though, specifically are the proposed changes to the Tier 3 not-for-profit standard, which is part of the Accounting Standards framework. First, we want to reinforce, though, that the XRB as an organization is not responsible for deciding the who when it comes to reporting. When we are determining who it is that has to report, that's driven by legislation, which is outside of our control. And for not-for-profits, until recently, the main way in which an entity was required to prepare financial statements in accordance with our standards was through the operation of the Charities Act 2005, under which all registered charities have to prepare financial statements in accordance with accounting standards issued by the XRB. There is an ongoing review of this Act, though, which is considering several issues, one of which is the reporting requirements for small charities. And recently, in April this year, there has been a new Incorporated Societies Act passed. That Act will require all incorporated societies, except those that are small, to prepare financial statements in accordance with accounting standards issued by the External Reporting Board. Between these two acts, that means that there are over 30,000 not-for-profit entities in New Zealand that are required to apply XRB standards when preparing financial reports. So that's a really big number of entities. And in order to ensure that the accounting standards that we issue are appropriate for those entities, we have done so through the Accounting Standards Framework, which divides reporting by these entities up into tiers. The table that you'll see on this slide shows the current tiers in the New Zealand Accounting Standards Framework as it applies to public benefit entities, or to PBEs, really, in New Zealand. PBEs includes entities across both the public sector and the not-for-profit sectors. The framework has 4 tiers with different standards that apply to each tier. The key difference between tiers 1 and 2 and tiers 3 and 4 is that tier 1 and 2 standards are based on international public sector accounting standards issued by the International Public Sector Accounting Standards Board, whereas the standards for tier 3 and 4 are New Zealand specific. That is, they were written from scratch by the XRB specifically for smaller PBEs. A PBE with total expenses of less than $2 million per year is able to apply tier 3, which is what we're talking about today. And then an entity with total operating payments of less than $140,000 per year is able to apply the tier 4 standard. And we have a separate deep dive session on the tier 4 standard and the changes that we're proposing there on Thursday, the 16th of June, so in a couple of days. The other criteria that you'll note on this slide is that an entity cannot have public accountability. While all PBEs are accountable to the public in one way or another, in this context, the term public accountability means that the entity has debt or equity instruments traded on a public market, for example, the New Zealand Stock Exchange, or it is deemed to have higher public accountability under the Financial Markets Conduct Act 2013. The number of entities that actually meet this criteria are quite small, and in general, if you're caught by it, you're usually aware. So for most entities, the primary criteria that determines their tier is their size. And for reference, when we're talking about registered charities, roughly 95% of registered charities in New Zealand fall into this range and are able to apply either the Tier 3 or the Tier 4 standard. So why do we have these standards at all? Having such a diverse range of entities, both in terms of their size and in the nature of their activities, presents a unique challenge for the XRB as standard setters, which is balancing the users and the preparers' perspectives. While the objective of financial reporting by PBEs is to provide useful information, preparing information always incurs some cost for that preparer. So what we mean when we say we're balancing those two perspectives is that we need to ensure that the cost of preparing information doesn't exceed the benefit of that information to users. Part of how we strike the balance is by having those 4 tiers of reporting, which have allowed us to develop less onerous reporting requirements for smaller entities. In the context of Tier 3 and 4, this means making the standards simple to apply for preparers while ensuring that the performance reports prepared using the standards still provide meaningful information that promotes public trust and confidence. Of course, achieving that balance isn't always as straightforward as it might seem. So that's where Tier 3 and 4 fit within the accounting standards framework. But what actually are these standards? They've been applied by public sector PBEs since 2015 and not-for-profit PBEs since 2016. And that not-for-profit group is the one that we're really focused on today. Bearing in mind that it would be entities at the smaller end of the scale that's applying the standards, many of them wouldn't have extensive financial reporting experience. A slightly different approach was taken when these standards were developed than would usually be taken for developing standards that apply to the larger entities in Tier 1 and Tier 2. Well, how is it different? The first and probably the big distinction here is that rather than having a full suite of standards, there is only a single standard that applies to each tier. So where you've got Tier 1 and Tier 2 not-for-profits applying 40 odd standards, for Tier 3, there is just the one standard that applies to not-for-profit financial reporting. To make these standards simple to apply, they were written using less technical language wherever possible, particularly focusing on minimizing the use of accounting terms. They also focus on making the requirements themselves simple to apply and to minimize the need to apply judgment or to make any significant estimates when they're being applied. The standards are also only intended to focus on the most common transactions for not-for-profit entities of this size, rather than attempting to provide guidance on all the possible transactions that they could enter into. Because these standards were new and very new when they were first written, in order to help entities to apply them, we also developed and issued template performance reports and other guidance notes which sit alongside the standards as a complement. But that brings us really to how we get to what we're talking about today, which is the post-implementation review that we conducted. After these standards had been applied by not-for-profits for 5 years or so, the XRB felt it was timely to check on how the standards were working in practice and whether they were achieving their intended objectives. In order to do that, in 2020, we started a post-implementation review, and we received over 100 submissions on that. The good news for us coming out of that post-implementation review was that we were told that overall the Tier 3 standard and the Tier 4 standard were working well. They were achieving their benefits, and nobody really told us that they should be just thrown out entirely. But of course, the feedback we got told us that they're not perfect. We were told that there were definitely some areas that needed improvement. And amongst the smallest not-for-profits, there were still some that were struggling to apply the standards. We got feedback on a lot of specific parts of those standards as well, but there were some areas that were raised more often than others. The 5 areas that were most frequently raised as needing improvement as it applies to the Tier 3 standard, which is what we're talking about today, are listed on the right-hand side of this slide. And those were the need to clarify and provide more guidance on service performance reporting, the appropriateness of the required categories that you have to group your revenue and your expenses into in the Tier 3 standard, that there's a need for a different revenue recognition approach to the approach based on a use or return condition that is currently in place in the Tier 3 standard, the need to add alternative measurement options for assets to the Tier 3 standard, and the need for some more disclosures around accumulated funds. And for all of these areas and others, we're proposing some changes to the Tier 3 standard, which is what we will now be going into. And to take us through the first of those, I'm going to hand across to Carly.
Thank you, Jamie. Sorry, technical difficulties as always. So as Jamie mentioned, we'll now be going through our proposed Tier 3 improvements. So first we'll take a look at the service performance reporting required in the Tier 3 standard. So what we heard from the post-implementation review is that many preparers are finding these requirements difficult to understand and apply in practice. And in particular, it was noted that the outcomes and outputs terminology was quite confusing. So we are proposing to make some amendments to the Tier 3 standard to align these requirements more with the Tier 2 PBE standards, in particular PBE FRS 48. And part of this alignment means we'll be moving away from the outputs and outcomes terminology. So this slide gives you an overall view of the proposals, and those familiar with PBE FRS 48 will notice a similar language used. The proposals ask an entity to describe what it is aiming to achieve over the medium to long term, describe the significant activities it has undertaken during the financial year to work towards those objectives, as well as its significant achievements, and also to quantify those activities and achievements to the extent practicable. So the following slides dive into these proposals in a bit more detail. So for an entity to provide information on what it is aiming to achieve over the medium to long term, it considers what its broader mission or purpose is. An entity's mission or purpose is the difference it is trying to make in the community, and this applies over the life of the entity. This information is either disclosed in the entity information section of the performance report, or it is incorporated by cross-reference from the entity information section to another statement or report available to users at the same time as the performance report. An example of this report would be an annual return provided to a regulator. The information required in the statement of service performance is linked to this broader mission or purpose, but more specific information will be required as the focus is on the entity's objectives in the medium to long term. So just to give a simple example of this, an entity's mission or purpose could be to help at-risk youth in the community. And in contrast, this medium to long-term goals or objectives could be to build a new community center and provide mentoring services. So when reporting on service performance information, a Tier 3 entity must select an appropriate and meaningful mix of measures and/or descriptions of activities and achievements that occurred in the financial year. These measures could be quantitative, so for example, providing the quantity of goods or services, or the time taken to provide the goods or services. They can also be qualitative, so for example, compliance versus non-compliance with a quality standard, or ratings such as low, medium, or high. And qualitative descriptions could also be provided, for example, those based on participant observations. The proposals include guidance on what makes a measure or description appropriate and meaningful. The entity's users and what they need to know should be kept top of mind here. The guidance links to qualitative characteristics that are already included in the Tier 3 standard that your information should have to make it useful to users. These are, the information should be relevant, faithfully represented, understandable, verifiable, timely, and comparable. The standard also emphasizes now that an entity does not need to report everything it has done in the financial year, only the significant activities and achievements. And again, the needs of users must be considered here. Would disclosure of the activity or achievement influence users' understanding of the entity's service performance? And if the answer is yes, then this is likely to be significant. The standard does not prescribe how an entity should present its service performance information. Graphs, tables, or images can all be used, whatever makes the information clearest to users. And finally, we have a new principle that we are proposing to include in the standard, which is that service performance information must be reported consistently from year to year. When there are changes to what is reported or how it is reported, an entity should explain the nature of the changes, explain the effect of the changes on the current period, and disclose the reasons for the changes. So possible reasons for changes include changes in the nature of the entity's activities from the prior year or from what was planned. It could be changes in descriptions of goods and services or the ways that they are aggregated, or changes in the measures or descriptions used. Just to note there, Tier 3 entities do not have to make changes to comparative information, but they can do so if they would like to. If they do, then they would need to disclose the effect of changes on the comparative information. So that brings us to the end of an update on our proposals on service performance information. We will now be doing a polling question just to get an idea of what you all think of the proposals so far. If you could just take a minute to answer yes, no, or unsure, and this will just give us some immediate feedback. Okay, so looking positive, but also quite a few unsures. If anyone would like to put a question in the Q&A that we can potentially address after the presentation, and of course, any comments we would love to receive over the consultation period. Okay, thank you for that. I shall now move on to revenue recognition. So during the post-implementation review, we received feedback that the use or return revenue recognition approach for grants and donations was too restrictive. Specifically, there were concerns that the approach does not allow a Tier 3 entity to recognize grant and donation revenue over time as the funding is spent, nor does it result in appropriate accounting outcomes in practice. Overall, Tier 3 entities want increased flexibility to defer revenue recognition when funding is received in advance of expenditure being incurred. So in response, we are proposing to remove the use or return condition and introduce a new revenue recognition approach for grants, donations, bequests, and pledges. This approach allows for the deferral of revenue when there is one or more documented expectations from the resource provider over the use of the funds, and the expectation has not yet been fully satisfied. So we'll go into some more detail on that. The flowchart you see here sets out an overview of the process to follow and consider. There are a few things to point out. So starting from the top, the revenue recognition approach applies only to grant, donation, bequest, and pledge funding. We do not expect that revenue from fundraising activities would have expectations attached which would meet the criteria as discussed on the next slide, or in any case would be a very rare circumstance. The new approach only applies to significant funding. This is to prevent entities having to spend time considering whether there are expectations attached to insignificant funding, which would probably not be useful to users. The expectation must be documented and agreed between the entity and the resource provider, and we will discuss this more on the next slide. The expectation should also be specific enough that the entity can reliably demonstrate satisfaction of the expectation to the resource provider, whether or not the resource provider monitors the use of the funds. And this is also discussed further on the next slide. So if all these criteria are met, the funding received is recognized as deferred revenue and a liability on the statement of financial position. Revenue will be recognized as or when the agreed expectation of a use is satisfied. And this will be discussed a bit later on in the presentation. So the proposed amendments include guidance on how an entity can identify an expectation for the purposes of the new revenue recognition approach. There are two key criteria to meet. The first one is the expectation must be documented and agreed between the parties. And here it is important to note that the expectation is one that the resource provider places on the use of the funds. An internal expectation, such as a management or board expectation, is not relevant here. An expectation and the agreement between the parties would likely be documented in writing in many cases. However, other methods are acceptable as long as there is some sort of evidence to show. So for example, a recorded Zoom call where the expectation is discussed and agreed would be acceptable as well. The second criterion to meet is that the expectation must be specific enough to reliably demonstrate when it is satisfied. This is the case even when the resource provider does not intend to monitor use of the funding. Therefore, there is no requirement to show or prove that the resource provider can enforce compliance. Rather, the intention of this requirement is to prevent a situation where there is a vague expectation and therefore makes it very uncertain as to when or how the revenue will be recognized in the future. Expectations which are specific include expectations that the funding will be used to provide specific goods or services, or acquire or construct specific assets. An expectation with a specific time frame is permitted. So for example, an expectation for the entity to use the funding to cover general operating costs over a 3-year period would be specific enough to meet the requirements. However, when there is not a specified time frame for general operating costs to be covered, then this would not be specific enough. And you can see some other examples of specific expectations on the slide to the right. Now we come to the timing of revenue recognition. So revenue is recognized as or when the expectation over use of the funding is satisfied, as previously mentioned. This could be at a point in time or over time, and there are 3 things to consider when determining the timing of revenue recognition. First one is the nature of the expectation. So for example, an expectation to purchase a vehicle would likely have a different pattern of recognition to one where you would be expected to construct a building. Judgment is also required to determine the pattern of revenue recognition. However, we are proposing to include several examples in the standard to assist entities, as you can see on the slide to the right. And one final point to note is that there may be more than one expectation attached to the use of the funding. Each expectation should be accounted for separately when determining when revenue is recognized. So that brings us to the next polling question that we have. So, do you agree with the proposal to remove the use or return condition and instead introduce the revenue recognition approach that we have just discussed? Now, if you could just take a minute to answer that. Okay, mostly positive, which is good to see. I know there's quite a lot of new guidance and concepts to come in, so I can see why there may be some unsurers. And again, you could just please submit any comments that you may have to us once you've thought about it a bit more and perhaps read the consultation documents. They'll be really helpful. Thank you. Okay, thank you. I'll now move on to Jamie on the next section.
Right. Okay, thank you, Carly. The next section that we have to go over today is the required categories of revenue and expenses in the Tier 3 standard. We'd heard through our feedback that some preparers are finding it difficult to classify their revenue and expenses into the required categories that are in the Tier 3 standard. And we also heard that this difficulty was resulting in some preparers still presenting their statement of financial performance with full lists of revenue and expenses from their trial balance. Often this could end up with a statement of financial performance going over several pages, which is a little outside the intention there. And in order to address this, we're proposing to increase the number of required categories by splitting apart some of the current categories that exist based on the nature and the source of the underlying revenue and expenses. Our view is that including these additional categories that should be used where they apply, it'll make it easier for entities to actually use those categories by making sure that each one is more clearly defined than the broader categories that we currently have. Of course, by providing these additional categories, that is going to create a bit more detail on the main statement of financial performance. So we also form the view that with these additional categories, there shouldn't be much need to do further disaggregation on the statement of financial performance. So we're proposing to remove that option. We will, however, be retaining the option for an entity to provide further information through the notes. That's not changing. And they will be encouraged to do that if they think providing more detail is useful. The other thing that's important to point out is that we are not changing the requirement around being able to change the terminology of the way that we're referring to those categories. So you can change the labeling of the category to use terms that are more appropriate or more reflective for an individual entity. It's simply that you won't be able to provide new categories or different categories or split them apart more on that main statement. But what actually are these categories? The table on the above slide shows the proposed categories for revenue in the Tier 3 not-for-profit standard. As you can see, the new categories we're introducing mainly come from disaggregating existing categories. In this case, specifically from disaggregating the donations, fundraising, and other similar revenue category, and also the revenue from providing goods or services category. The donations, fundraising, and other similar revenue we're proposing to split into donations, koha, bequests, and other fundraising, capital grants, and other grants. And I'm sure that you've encountered the term capital grants before, but to clarify, we mean a grant which is given specifically to be used in purchasing or constructing a large asset or fixed asset. The revenue from providing goods or services we're proposing to disaggregate into funding from service delivery grants or contracts with further disaggregation based on the source, that is whether it's government or non-government, and sales of goods or services arising from a commercial activity. These ones are the more significant changes, so I'll be coming back to these shortly to explain what we mean by each of those terms. But before I do that, I will just show you the proposed new categories for expenses in the Tier 3 standard. Like the revenue categories, the new expense categories we're proposing come from disaggregating existing categories. We're proposing to split the employee remuneration category and into proposing to split the volunteer and employee related costs category into employee remuneration and volunteer and other employee expenses. We're also proposing to disaggregate costs related to providing goods or services into expenses that are related to the sale of goods or services as a commercial activity and other expenses that are related to the entity's objectives. So the main things that it exists to do. Now, this term commercial activities, what do we mean when we say that? As this is a new concept for the Tier 3 standard, we're proposing to add a definition of commercial activities, which is activities conducted by the entity with an intention to derive a surplus and which do not in themselves contribute to the achievement of an entity's stated purposes. For example, you could be an entity that provides free mental health services as a main not-for-profit activity, but which also sells clothing to generate additional funding to provide those services. Even though the funding that you get from selling that clothing is intended to be used by that entity to achieve those objectives, the selling of the clothing itself doesn't actually deliver on those objectives. So that's really the distinction there. But we don't think that all activities that fall on either side of that distinction should necessarily be split apart as commercial and non-commercial. So whether something represents a commercial activity of this kind is also going to involve some judgment. First is the primary purpose of the activity. Is it primarily to derive a surplus, or does it have another purpose which deriving that surplus is secondary to? For example, an entity might derive a surplus, but primarily the activity could be an opportunity to promote awareness of the entity and their activities. The other consideration is really the entity's intentions for the activity. Does the activity that they're conducting represent a sincere intention to conduct a commercial activity? Do they really mean to be, say, running a business? For example, are the activities conducted at a scale or with sufficient structure to imply that there is that kind of an intention? Or are they smaller, more ad hoc activities that are being carried out without any real formalizing of how that's done in such a way as to imply that there's a sort of commercial activity? Another example could be the frequency. Does the entity regularly engage in this activity? Is it selling things on an ongoing basis? Or is it just sort of done intermittently? It's easiest to illustrate all of it really with some examples, and we've got a couple on the right-hand side of the slide. So consider the difference between an entity that has a dedicated site that regularly produces and sells baked goods versus an entity that occasionally has a cake stand at the local fair. While both of those do involve selling baked goods and deriving a surplus, the former gives a much greater impression that the entity is intending to operate a commercial activity than the latter. That does raise the question, though, of how to treat the second example. If it's not commercial, then what is it? We're proposing that in these cases, it's more appropriate to treat these activities really as fundraising activities and including it in that grouping as opposed to this commercial activities grouping. Next is the other one that I pointed out, the service delivery grants or contracts. So these are the grants that are received from the government or other agencies that are in substance a contract for the delivery of goods or services. Whether a grant meets this definition is going to involve some judgment again, and listed on the slide here are a couple of factors that you could look at. First really is how closely related the funding is to the specific services that are being provided. Think of a lump sum grant that is provided with a general purpose to help an entity provide counseling services versus a grant that's received for the delivery of a specified number of counseling service hours where the total grant is calculated based on the total hours to be provided. The latter might be more likely to be a service delivery grant than the former. Another factor could also just be the timing of the payments. If their funding is only determined and receivable by an entity after it's provided a good or service, it's more likely that the funding is a service delivery grant or a contract than something where there's a sort of guess and it's provided up front. For example, an entity might have an agreement where it receives from a funder $10 for every school lunch that it provides within a specific time frame. That looks a little bit more like a service delivery grant than something where they just receive $10 for an estimated amount of lunches, and it's just sort of the general lump sum that they're provided with. And of course, just pointing out again that as I raised, we are proposing that where you've got grants like this that are being received from both government and non-government sources, these should be split apart on the statement of financial performance. And I believe that brings us to the next polling question we have, which is about the required categories. So based just on the results I've got so far, I can already see that this is a little bit more contentious, and that's not entirely surprising because not-for-profits are all obviously very different, and there is some challenge there in providing a set of categories that are going to be appropriate for most of them. If you have any particularly strong feelings, of course, as we keep reiterating, we really do encourage you to either ask us a question or to ideally make a submission on what you think would be the most appropriate categories to have. And that's talking about the required categories, but now we move to the alternative measurement options for assets. This was a very popular area for people to comment on, and many of our respondents told us that the Tier 3 standard should include simple requirements for revaluing assets rather than forcing an entity to opt up and apply the Tier 2 standard. No, I think we can see, yep, you can see the results there. Yes, rather than applying the Tier 2 standard to revaluing assets. So we're proposing to add the option to revalue assets to the Tier 3 standard, but we are proposing to include some limitations on this. In order to keep this standard simple to apply, we're only looking at adding this option where revaluing an asset doesn't require a significant amount of judgment or estimation. And we're adding this option for property, plant, and equipment, for investment property, and for publicly traded financial investments, such as shares and bonds. Conveniently, this list is also consistent with the types of assets that respondents told us that they wanted to revalue. We didn't really get any questions for complex financial instruments. It was really for these more straightforward asset types. We are, however, introducing some simplifications to make it easier. We are retaining the option to use rateable value for land and buildings. So for these asset types, we're proposing that you would have a choice between rateable value or an independent valuer, independent valuation. For investment property, we're proposing that these will be treated in the same way as items of PP&E. We're also proposing that these PP&E and investment property revaluation movements are to be recognized directly through a reserve in equity or accumulated funds, rather than introduce some more complex requirements for other comprehensive income to the Tier 3 standard. And for financial investments, we're proposing these revaluation movements will be recognized through the statement of financial performance, and so not through that equity reserve. But let's look at each of these in a little bit more detail, just to reinforce what we're talking about here. So for property, plant, and equipment, we are proposing that PP&E assets, you'll have a choice in terms of land and buildings at least. You will either be able to have that value, that current value, measured based on a valuation by a suitably qualified independent valuer, or for land and buildings, it will also be an option to use a local council rateable value. Which assets will you be able to do that for? For basically all PP&E assets, they'll be eligible for that kind of treatment, but there are a few conditions. So if you want to revalue an asset, you'll have to revalue the whole class. You won't just be able to pick a specific asset and revalue that. Once you switch to revaluing, you would need to continue revaluing those assets going forward. You don't get the choice, at least not without having a very, very good reason, and that would be exceptionally rare, to switch back to measuring based on cost. And once you do start doing this revaluation, you'd have to make sure that the assets are revalued on a regular basis. How frequent this would need to be will really depend on how much the value of those assets tends to change. It just needs to be sufficiently regular to not differ from what the current value would be. So presenting your changes in value, they'll be presented as a separate revaluation reserve within accumulated funds. Any gains that you recognize will be recognized directly into this reserve, unless they are reversing a previous revaluation loss, in which case they will be recognized through the statement of financial performance. And the inverse, any losses that you have would be recognized as an expense unless they reverse a previous gain, in which case they will then be recognized through that revaluation reserve and reducing that reserve. Investment property. This is new to the Tier 3 standard. There actually wasn't a definition of what we mean by investment property. So we are proposing to add one. And the proposal is to define these assets as a class of property, plant, and equipment, which is held primarily by the entity to generate rental income or for capital gains, rather than for use in the entity's ordinary activities. Other than that, in order to keep the standard simple, we're proposing that these assets would be accounted for in the same manner as other property, plant, and equipment assets. So that means there'll be a choice. You can use either the cost basis or revaluation basis. And if they are being revalued, the movements in value will go through that reserve, with gains going in the reserve unless they reverse a loss, and losses recognized as an expense unless they reverse a gain. Finally, for alternative measurement options, we have the proposals for financial investments. We're proposing that these investments will be able to be valued based on their current market price. For example, an NZX quoted price at the balance date. Again, as the intention is to keep the Tier 3 standard simple, we're only proposing that you'll be able to do this for financial investments which are publicly traded. And in this case, it's because determining the appropriate value will not require significant judgment. It's available from external parties. For example, this includes shares that are traded, bonds, units, and managed funds, where they can either be traded or they can be valued based on a report, say, that you get from your fund manager. And for these assets, we're proposing that the changes in value are recognized as revenue or expenses in the statement of financial performance. We're also proposing that if an entity is revaluing any of these kinds of investments, they'll be required to disclose a reconciliation of the movements in their investments as part of the notes to the performance report. If an entity is electing to report all of these investments at cost, they wouldn't have to do that reconciliation. And I believe that brings us to the next polling question, which I will launch now. So as I see the results coming through here, it's looking a bit more positive on this one than on the required categories, which is nice because I believe this is what we were overwhelmingly told people were had wanted. So it's good to see that we haven't misinterpreted or gone too far off the mark here. And I will just share the results so you can all see. 75% agree and roughly 20% are unsure. So please, again, tell us what we might need to clarify. And conscious of time, we are moving into the last substantive section here, and it should be relatively brief. And this is the last from me, which is our proposals around accumulated funds. So this is quite a popular topic of discussion around not-for-profits. And among the respondents to the PIR, we heard that there should be greater transparency about an entity's approach to managing its accumulated funds and any specific reasons that it might be retaining funds for the future. In response to this, we're proposing some additional disclosure requirements in the notes to the performance report, which provide information about how an entity manages its accumulated funds and how an entity is expecting to use its accumulated funds to advance its objectives in the future. We have already received a few questions about these disclosures. So included on the slide is the wording from the exposure draft of the Tier 3 standard. Specifically, we're proposing that an entity discloses information that enables users of its financial statements to evaluate the entity's objectives, policies, and processes for managing its accumulated funds, and a brief description of the entity's general plans for applying its accumulated funds to its purposes. Information an entity could consider disclosing as part of this. It includes whether there are any specific projects that it intends to begin in the future, details of the extent to which accumulated funds are tied up in assets it uses to carry out its purposes, or whether it has any intentions to make a specific future distribution. It's important to highlight that these requirements are only intended to provide a brief, high-level description and mention any significant activities to provide an overall picture. We aren't expecting entities to disclose information which could be considered commercially sensitive as part of this disclosure, nor do we expect that entities would need to provide huge amounts of detail that go on for pages. We also really want to reinforce that nothing an entity reports as part of this is really intended to represent a binding commitment or a promise that something specific is going to happen. The objective is to provide readers with enough information to form their own overall impression about what the entity plans to do going forward in general. And I believe that brings us to the final polling question here. Still positive, but a little bit more mixed. So you can see. And with that, I will hand over to Carly to wrap up.
Thank you, Jamie. So just very briefly, let's go over a few other areas where we've made changes. So on the entity information section, I mentioned previously that a Tier 3 entity can incorporate by cross-reference the entity information, the requirements in the entity information section from another report. So this is a change that we've made just to make it, just to make duplication or to lessen the duplication that an entity may face. Then we have made some changes to the definition of cash. So we've aligned this more with Tier 2 PBE standards. So we've included other short-term deposits in the definition of cash, but we haven't brought in any other cash equivalence guidance. And for the opting up requirements, Tier 3 entities will still be able to opt up to Tier 2 PBE standards, although this may be less applicable now in light of the proposed changes, as we've discussed. And we have also clarified that where PBE standard requires amounts to be put through other comprehensive revenue and expense, for Tier 3 entities, they'll put through these amounts directly in accumulated funds. So we are not proposing to introduce other comprehensive revenue and expense section. So next steps, you can view the full consultation documents and the at-a-glance document on our website, along with the exposure drafts. And we encourage you all to please comment on our proposed amendments. The comments that you've put through in this presentation, we will be downloading and considering as part of all the other submissions that we'll hopefully receive. And we can submit these comments via our website or by emailing accounting@xrb.govt.nz, and the consultation closes on the 30th of September. So now we'll come to some questions.
Okay, so let's have a look. We've got a question here about whether we can get rid of the requirement to depreciate buildings that are valued at GV, which I'm assuming means government valuation. That is a good question, and it's actually something that we did discuss, not specifically in the context of government valuations, but revaluation of property, plant, and equipment in general. And that is that we are keeping the requirement to depreciate any assets that are being revalued. That's not changing, and we've actually made it more explicit that you are going to be required to do that. We've got a question here about if an entity has a leased asset, is there any proposal to value the lease? I've actually had a question like this at a previous presentation, and at this stage, we aren't looking at doing anything around valuing leases. And I'm assuming this is being referenced due to the changes for tier 1 and 2 entities and the leasing standard there. If we get overwhelming feedback that people want us to address this topic, that's really going to go back to the Accounting Standards Board to consider if there's anything they want to do there. But at this stage, there's nothing that we are proposing. We've got a question about the employee remuneration costs, whether that category includes only staff on salaries or wages, or would it also include people who contract to the organization as, say, a CEO? This would really just be my impression here, because this hasn't been explicitly considered, but anybody that's being employed by the organization in a role would be captured within that. I don't see any reason why that would need to be separated out. Another question about categories, which is whether local government grants are considered as government or non-government. In general, I would consider local government to be part of the government category rather than non-government. And I've got one here for Carly, actually, which is about the qualitative characteristics in the service performance reporting, I'm assuming, and whether that's auditable. So maybe you have a comment on that, Carly.
Yes, so it would depend on what sort of qualitative comment it would be. So the example I used in the presentation, where I used participant observations as an example of a qualitative description, there should be some sort of evidence that the auditors can see to verify that these comments were actually made by somebody, well, by the participants. And in fact, there is some guidance around the guidance document on PBFRS 48, which actually sets out what entities need to consider before getting their audit ready. And that would be one of the items, is to make sure that you have documentation that can support the descriptions that you are wanting to use. So we can think about, well, we can relook at the guidance, of course, as part of our consultation.
Thanks for that, Carly. And I believe that lands us right on the end of our time. All the other questions that we've received that we haven't answered, we will be downloading and we'll have a look at those. And if possible, we'll come back to you on those details. But thank you all very much for attending today, and we look forward to receiving your comments. Thank you.